Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back at the end of the week for another weekly market recap with my good friend, Lance Roberts. Hey, Lance, how you doing?
Sounds good. How are you?
I'm good. I was actually going to introduce you as Lance Roberts, AKA Spider Lance.
Exactly.
Friendly neighborhood web crawling financial advisor. And
Exactly.
I've got the image up here of you during this recent Halloween.
No, I appreciate that. That's awesome. Yeah. Next year's Halloween costume is even better. I've already got it picked out. So.
Okay. Well, that's a pretty high bar. It's an uncomfortably high bar you set with the Spider-Man costume. So it's going to be great.
Don't worry. Next year, I've already got it topped. So.
Okay.
Yeah.
Okay, good. All right. Well, look.
Hey, by the way, I don't know if you saw my picture today. We used to back in the day wear neckties all the time. So I actually figured out a way to put neckties to use.
Yeah, I saw that photo, which I'll put up here of you walking your dogs. I guess somebody misplaced the leashes, so you had to get creative, kind of MacGyver a dog leash. That picture really says to me that you do not wear neckties much anymore.
Not anymore. I don't know anybody that does anymore, honestly. I mean, back in the day, everybody wore ties, but really ever since COVID, it's now no tie. But I mean, we still wear, suits and shirts to work, but nobody wears a tie anymore. So I had to do something with them.
Yeah, well, and I'm sure since you probably wore them early in your career, I mean, I still have PTSD from my memories of not only being in suit and tie, living in Manhattan, working for an investment bank, but having to willingly crawl down into the New York subway on a hot, humid August in that wool suit with the shirt and tie, and just have to suffer the suffocation of getting to work and just emerging just drenched, right? So thank goodness those days are behind us. Look, we do have some sweat-inducing developments from this past week to talk about here, cold sweat-inducing.
Yep.
And most notably with this market, it got kind of kicked in the gut this week when Fed Chair Jerome Powell started talking. So why don't we start there? Fed basically made good on its plans to raise the Fed funds rate by another 75 basis points, which they did. Then Jerome Powell started talking, and the markets did not like what they heard.
Well, no, that's absolutely right. The markets were already priced for 75 basis points this meeting. Markets were looking for a step down in rate hikes going into December, January, and the next two meetings in 2023. And immediately after, immediately after the FOMC just kind of released their initial minutes or their initial statement, stocks actually spiked. We were down on the day. Stocks spiked by about 50 points in just a matter of minutes. And then to your point, then Jerome Powell started speaking. And, this was very reminiscent. And I've actually, I've talked about this previously, but this was very reminiscent back to what we saw in June and July and August. Now, you'll remember back in late June, you and I were talking about the market's very oversold, lots of negative sentiment, we're due for a rally. And then the market started putting together this whole, hey, the Fed's going to pivot and this kind of whole narrative. And the markets rallied in July and into August, right into the Jackson Hole Summit meeting. Now, the important thing about that meeting was that Jerome Powell had a presentation prepared. And just before he went out to make his presentation, he scrapped the whole presentation, rewrote it, very short statement, said basically, we're not anywhere close to a pivot. And that was where stocks started selling off in August and September.
Right. And presumably because he was frustrated that the market was beginning to ease conditions in advance.
Yeah. And so this is the key thing, right? And so that you're absolutely right. That was the point I was going to get to, which is he just did the same thing again. Markets are rallying into the meeting. The last thing that the Fed wants right now is a strong market because easy conditions to tighten financial conditions. They want to slow economic growth. They want to slow employment. They want to drop inflation. And the markets keep going, hey, you're going to pivot. We think you're going to pivot. So they keep running up stock prices, which eases financial conditions. And so again, here's this meeting. Markets are going into it with this idea the Fed's going to pivot for some reason. And Jerome Powell says, we're going to fix this problem real quick, and says, not only are we not going to pivot anytime soon, in fact, we may have to hike longer than we thought. And that sent the Fed fund futures up to potentially about 5.25 now, from 5% being the terminal rate, and really sent stocks into a tailspin on Thursday.
Yeah, and I want to just reiterate those numbers for a minute. So with the 75 basis point hike, we're now, and the Fed gives these Fed funds rates and ranges.
Just call it 4%.
Okay, but yeah, okay, 4%, right? And you're now saying, post guidance, folks are now thinking it could go up to 5.25%, right?
Yeah.
So
now,
that's
pre-meeting it was only 5. Target the terminal rate was estimated to be 5. Pre-meeting, post-meeting is now gone to 5.25.
Right. So that's like what I want to flag is like that's still like 30% higher from where we are right now with this most recent one. Like it's material, right? And yeah, this was the quote that I think really got the markets was when Powell said the ultimate level of interest rates will be higher than previously expected. And then he started saying, hey, it's way too early to start thinking about a pause, and really just tried to tell the markets, look, give up these pivot dreams. Yeah. Right. Like, what I'm going to do at some point is, we'll stop, but we're going to hang out there, because we're going to hang out there to, as you and I have talked a lot about, we know we've hiked a lot. So we want to see the impact of those hikes, because there's that delay between when the Fed raises rates and when they actually affect the system. So he's basically saying, expect us to go higher than you thought, and then we're going to hang out, guys. Like, we are not pivoting here.
Yeah, that's bullshit.
Well, I know you think so, but I got to say, I got to challenge that a tiny bit, which is this year, and I know all the reasons to be skeptical of the Fed and Powell, but this year Powell has, if anything, he has delivered on what he said he was going to do.
Well, no, I just mean the hanging out at some higher terminal rate. Like, we're going to get to 5.25 and just hang out there for a while and see what happens. That's not going to happen. In fact, he even made the statement. So for all the bulls that are looking for a pivot, he gave you the language. In his press conference, he said, hey, if we over tighten, no big deal, because we've got the tools to support economic growth, which he just told you that what they're going to do is they're going to hike rates. They'll over tighten. When they break something, they're okay with breaking something, because then they'll just go immediately back to zero rates in QE. So Jerome Powell told you that they're going to hike rates until, basically, this is it in a nutshell. We're going to hike rates until we break something, then we're going back to QE. So there's going to be no hanging out at 5.25% for 6 months, waiting to see what happens. Once we get to 5.25, we're already going to be breaking something. There's a 2 million job, actually 2.8 million job deficit right now between January of 2020 and today, in terms of what the BLS reports as actual jobs. And
we're getting there in a second.
Yeah. So, the economy, and you've got every day now more layoffs from companies. Every day you're getting more layoffs. So it's all, this whole, environment where Jerome Powell thinks like, oh, we're just going to hike rates and we'll just hang out for a while. It's not going to happen, because when the brakes hit on this, and I talked about this last week on the radio show, when you're driving a car, so you're in a car and you're going down the freeway, right? Or down a really straight road, right? You got and the gas, you got your foot pressed to the floorboard on the gas, right? So you're speeding down this. Now, down at the end of this road, you can clearly see there's this really big oak tree and a sharp right-hand turn. So, now normally what you would expect is you start to kind of put on the brake, maybe let off the gas a little bit, kind of slow down so you can navigate the turn. Fed's not doing that. They're just keeping the pedal to the metal, and they'll hit the tree. And so when they hit the tree, then they'll go, okay, great, now we got to turn. Right. It's kind of like that. I don't know if you saw that NASCAR race where that guy went from, I can't remember his name, is Mark Cody, I think. Anyway, he was in the back of the pack and he just nailed it, and then ran around the outside of the wall and wound up finishing like in 8th place. But it's kind of the same attitude, right? Don't worry about the obstacle. Just drive as fast as you can till you hit it, and then make your directional change at that point.
All right. I'm going to make a note here to see if I can find that clip. If I can find it.
That clip is all over the place. It's freaking hysterical.
Ross Chastain used the wall all the way around this racetrack.
All right. So, okay. So for the record here, you feel pretty confident that we get anywhere near 5.25%, things really start breaking. Use whatever analogy you want. We hit the wall, we hit the tree, the wheels come off, whatever. And you think the Fed will, that's when we'll see the pivot, regardless of what Powell's saying.
Yeah, exactly. And look, I mean, Powell even told you that. He just said, look, he said, we've got to get, and he said over tightening is less of a threat because we have tools to solve over tightening, right? We have QE, we've got zero interest rates, we can support economic growth. What they're afraid of is this, and I think they're wrong, right? Honestly, and I know that high prices are a cure for high prices. They're worried that this kind of inflation spike that we've got was caused by some organic thing in economic activity that's going to be here forever. And what they're worried about is this inflation gets stuck here for, at this higher level if they back off too soon. Maybe, possibly. But the problem is that, again, you didn't solve, we sent people checks to households, we shut down the economy. Look, production's coming back online and money's running out.
And that pig will get through the python at some point. Yeah.
So I think they're worried about an inflation boogeyman that really doesn't exist because, 40 years of history tells you that we've had declining rates of inflation because of too much debt. And we haven't solved we didn't do anything to solve that debt problem. And, so I think they're fighting an inflation boogeyman that really isn't there. And that means that if you're doing that, you're going to wind up causing another problem because you've way over tightened rates for something that wasn't really an organic inflationary issue.
Yeah. So this is point I was going to get to in the jobs, but we'll mention it here and then we'll get into the jobs part. So I did 2 interviews this week, one with Jim Rickards, one with Stephanie Pomboy, both basically on that exact topic, which is even though we're all understandably laser focused on inflation right now, is disinflation and deflation really the bigger bad in the story that we really need to be focused on? They both definitely agree. Jim did a really good job explaining how there's 2 types of inflation: demand pull and cost push, and that we have definitely had cost push inflation with a lot of the supply chain issues and stuff that we've had, but very much in that space, high prices are the cure for high prices, right? With the demand pull, he said we really don't have that, and without it, we're not going to get into that inflationary mindset and upwards spiral in prices. So he thinks that all the other forces out there that are much more contracting for economic growth are going to, and more likely sooner than later, really start to pull the CPI back down to earth here. So you're nodding as I'm saying all this.
No, look, just so that, let's just do a little bit of clarification, just so everybody listening can, understand what you're saying. Demand pull inflation is what we call an organic inflation. And this is what we had back in the 70s. Back in the 70s, we were manufacturing based. We were producing a lot of stuff. Everybody kind of lived moderate lifestyles. Debt to household ratios were about 60% of net worth. So people had high rates of savings. They were working. And as the economy was growing, we were growing at 6, 7, 8% growth rates in the economy. So wages were rising. And yes, inflation was rising because economic activity was rising because people had money to spend. And so that was what they were doing is they were demanding more goods because they had more money to spend. And then as you demanded more goods, businesses were going, hey, I've got demand, let's produce some more stuff and we can raise our cost a bit because we can raise our cost and people keep buying it, right? Raise our cost, people keep buying it. And so that's demand pull. So demand was organic. So you were pulling this kind of inflationary rise in prices on an organic basis. It was a good, healthy, strong economy. Today, what we did back in 2020 is we did just the opposite, right? So we just gave people money and said, go buy stuff. and so what we did is we pulled forward we did pull forward about 5 years worth of demand to today because we gave people money to spend. But there's not this organic wage growth that allows people to keep spending and saying, okay, I can afford more because I'm making more. I can afford more because I'm making more. I can afford more because I'm making more. That's not occurring. People are running out of money very quickly. We gave them money, they've spent it. Now they've gone into debt, ran up credit card debt, they're spending as fast as they can, but that's about to run out pretty quick. So this whole idea of this demand pull is about to go away, fairly quickly.
Right. And where demand pull really becomes a problem is when people start losing faith in the currency and they start thinking, this is what you sort of see in, banana republics, where they start worrying that the purchasing power of their money is going to be materially less at the end of the week. And so as soon as they get it, they rush out to spend it. Right. And so that then creates this artificially high, demand pull saying, hey, look, we need stuff right now because we're afraid that we're not going to be able to afford it tomorrow.
Or you can't get it. Right. And that's what we had.
Yeah, exactly. Or you can't get it.
The big rush to go buy toilet paper because we're all running out of toilet paper, heaven forbid. Right. So you have, and again, a lot of this inflation that we're talking about, a lot of it's very artificial in nature, but there's this huge, what people don't understand is there's this huge void that's sitting out there. And unfortunately, we've been doing this for over a decade now, with QE and all these other type of things, is that we keep pulling forward demand and that leaves a void in the future. And this is why every time that we stop QE or we stop doing some type of artificial intervention, the economy immediately starts to head towards a recession. Then we have to start it all over again. And we do it again because every time we start to stop these type of artificial interventions, everything starts to fall off the cliff because there's that big void sitting there that we now need to figure out a way to refill it. Well, now the problem is that void is so big, and now the Fed can't go back. There's this whole breaking point in the economy that's coming next year where, I think you're going to start seeing this post midterms. But once we start getting into next year, I think you're about to see a very sharp fall off in activity because we're going to hit that where that void is that's sitting out there that we're going to have to fill next.
So I actually talked about this a fair amount last week with your colleague, Michael Leibowitz. And that's basically the Lacey Hunt argument that you're making right there, right? Is he has said forever, look, this big deflation vortex is the thing that we really need to be worried about and figure out how to solve. Lacey then said, hey, I get it. On the way to trying to slay this big deflation dragon, this inflation one showed up. We got to kill that guy first. But the key thing to remember is, hey, if we successfully do that, we still have this massive deflation dragon that we got to deal with, right? And if the system, I feel like I'm saying this in a lot of interviews recently, if we just took our hands off the system, right? If every central planner just said, okay, I'm not touching a thing, right? The system would instantly deflate. Right. Yeah. There's so much malinvestment out there. To your point, Lance, we've pulled in so much future demand, and we have so many bad debts out there that the system, if left alone, would just self-correct, right? And be this massive, super painful deflationary crunch. And no politician, standing politician will ever allow that to happen on their watch. But, you imagine, geez, if we just did that, yeah, it'd be massively painful. But we'd get everything kind of out of the way, and then we could start from a much more healthy, sane baseline and hopefully do things a little bit better going forward, right? And all what we're going through and all what we're probably likely going to go through for the next couple of decades is really just the attempt to try to prevent that reality from happening.
Yeah. Well, and look, and this is from your mouth to God's ears, right? But, this is why, people run around and say, we need to get back on a gold standard. This is why we can't, right? If you got back on a gold standard right now, you would cause a massive depression.
Because it would enforce discipline that would cause that repricing. Yeah, exactly.
Exactly right. So, and so, the whole world is dependent upon this idea that we can just print more money, issue more debt, and it's all going to somehow magically be okay. And this has been the solution. This is, this is Stephanie Kelton's whole idea, which was flawed up front. Her idea was, her whole idea of modern monetary theory was, the government's debt is somebody else's asset. So it's always a zero balance.
Yeah.
Right. And it's complete. I mean, it is true. The government issues debt and somebody buys the debt, but
it's on someone's balance sheet, but it doesn't mean it has any value. Yeah.
Well, and not only that, though, there's the function of that the debtor still has to pay that debt. It's not, free money just floating around somewhere. And that's what the real problem with all this is that, we just keep going further into debt because the only way that we can see a way forward is we got to keep paying for this stuff. Right. And, we've gotten to the point where, we all have a big cousin, Vinny, the guy that never works and always borrows money and never pays you back. Well, if paying him, he falls to keep paying, right? And we just got to keep doing what we're doing. And this is why all these ideas, and I love politicians that run around like, we're going to balance the budget. Yeah, whatever. You're not going to balance the budget because you can't. You're not going to get reelected if you try to balance the budget. And so, these are all great things. We're all having midterm election talk right now, right? It's midterm elections next week. And there's going to be, we're going to vote for change. You're not going to vote for any change because you can't afford the change. And, we all want it, and it's nice to talk about it. But at some point, you've got to realize that if you want change, and if you want to be, if you want to generate better economic prosperity, you didn't get here overnight. You're not going to get out of it overnight, and it's going to take a lot of pain. It's like, it's like trying, Adam, we talk about fitness on the show a lot here from time to time. You didn't get really overweight overnight. That took years of effort, and hard work to get really overweight. Well, you're not going to get back in shape overnight either. It's going to take a lot of time and dedication, effort at the gym, dieting, forgoing the things that you want to do. You'll get there, but man, the journey sucks. I mean, there's just no way around it. And it's the same thing with economic growth. We keep looking for easy solutions, to get back into fiscal shape, and nobody wants to do the work.
So that is exactly my rant for this week. So we'll come back to that point in a little bit, or maybe in an hour and a half, or however long it takes us to get there.
Let's go there now. We'll wrap it up in 30 minutes. We'll be good.
Yeah, wouldn't that be amazing? So you mentioned the jobs report. So I just want to make sure we talk about the points of that just for folks, because it's a material step along the journey we're on here. So the October payrolls numbers came out 48 hours ago. They jumped by 261,000, which was substantially higher than what was expected. I think they were expecting about 195,000. This is yet another one of those head scratchers, Lance, right? Where we're kind of looking at the rest of the economy, and then, these BLS numbers come out and say, hey, everything's, phenomenal, right? So a couple of things that are notable about this. First off, just to show the juxtaposition, the day that this report came out, I just want to show this tweet that said, okay, here are the layoffs that were announced in the 24 hours preceding the release of these great payroll data. Lyft laid off 13% of workers. Open Door laid off 18%. Stripe laid off 14%. Chime laid off 12%. Twitter laid off 50%, or actually they're laying them off today as you and I speak, Lance, but they were announced the other day. And then Morgan Stanley announced layoffs as well, unknown amount. But point there is, you and I have thrown up a lot of stats like that over the past couple of months as more and more companies have been laying off here. Just an increasingly, big dichotomy between what we are seeing and what we are being told reality is, right? It's like the weatherman on TV telling you sunny skies, but you're looking out the window and it's clearly raining, right? So real quick, because I know you've got things to say about this. The other really notable part of this is, there are different methodologies that are used to track employment. And we are seeing a continued growth of the gap that you and I have been talking about between the establishment survey numbers and the household survey numbers. And basically, since about March, the household numbers have been flat, like almost tabletop flat, whereas the establishment numbers have just kept growing on their same trajectory. Now it's about a 2.3 million jobs gap between the two. That has to do, with methodologies, and a lot of people think it has to do with, kind of tinkering to make things look better before an election. We've obviously got the midterms next week, but if you look at all the other different methodologies that are used here, what it seems to show is that there's been no growth in people working this year, in the number of people working. Where the growth has come is in the number of people having to now work multiple jobs, which actually tells a very different economic story, right? That says, hey, people are actually struggling and they're having to go out to get supplemental work to be able to sort of stay afloat, right? So, you look at the headline numbers and it says everything's great. You dig down and it actually tells a very different story.
Yeah. Well, no, and we talked about this before, but, first of all, look at where the jobs are being created, first of all, right? The vast
Leisure and
majority,
hospitality.
or leisure and hospitality. But those are your lowest wage paying workers. Those are the most temporary of jobs, right? Because they get fired, business goes out, they get laid, terminated, what off, or they're quitting. But look, it's even my kids. Both of my kids are in college right now, and they've got to pay their way through school. So what are they doing? So they're going to school. They both drive for Uber. They both drive for Lyft, and they're both doing DoorDash. So those are 3 jobs that they're working to make ends meet, right? So they're considered full-time employed, even though they're working part-time at 3 jobs. But that's what's going into this multiple part-time job thing. People aren't working a full-time job and working a gig job. They're working 3 or 4 gig jobs, just trying to get full-time work put together. And, that's not, to your point, that's not the sign of a healthy economy at all. But just so, everybody listening is aware, the household survey is the survey that's the data that the BLS takes and then derives their employment report. And so they do a lot of mathematical adjustments. They do these ex-arma adjustments. And what's interesting is for a good example of these adjustments is what's called the birth-death ratio. And this is the number of businesses that are created versus the ones that die or go out of business. So Adam goes out, he wants to, he starts Wealthion. He's a one-person shop. He starts a business. They call him up on the survey and they say, "Hey, Adam, you work?" He's like, "Yep, I'm self-employed," right? Mark him down. He's working. So what they assume is that if somebody creates a business, that creates a job, at least one. And so they count that. And so but they really don't have an idea of how many businesses are getting created from month to month. So they just kind of throw a wild guess at it. And what's interesting is if you take a look at the business survey data, there have been basically a flat number of small businesses. In other words, the birth and the deaths are just about the same. And then we got into 2020 and had a big drop off in businesses. And those really haven't come back to any great degree. But every month, the BLS is adding a couple 100,000 jobs in terms of these births that are getting created, even though there's actually been a reduction in the number of businesses over the last several years. So so part of that gap is just coming from these guesses that they stick into the data. I'm not saying there's anything nefarious going on. They're just trying to figure out, what this is. But, what frustrates me is there's easy data to get to. And I even fault ADP for this because ADP has the data. ADP knows exactly how many employees were hired for what. I mean, you fill out the form. If you're an ADP contractor, if you use ADP to do your payroll, I'm paying Adam. He's full time. Here's 40. He works 40 hours. Here's his hourly pay. Here's his 401k contribution. Everything. Jim, he works part time. We pay him $5.95 an hour, right? Whatever it is. ADP knows that data. And even they do all these funky adjustments for some reason. Just report that data. That's the most accurate data we would have on employment. And if I had access to the data, I'd do ADP and paychecks. I'd throw those together in one bucket, count the actual jobs, because that's your most accurate report of whatever you're going to get. And there's no reason to ever go back and need to seasonally adjust that data, but they do it for some reason. So, and I don't know what the benefit of it is, but I mean, we've got really accurate data out there. And, here's another thing with the BLS report, throw all those adjustments out. You don't need them, right? You take the non-seasonally adjusted data, you do a 12-month moving average that smooths out the bumps of seasonal hiring, right? And you get a much more accurate indicator of economic growth and employment growth than you do doing all these seasonal adjustments. So, there's simple solutions to this stuff, but I don't know why we have to do all these maturations to try to keep people employed. It would take one economist with a computer and that'd be done.
I know that there are simple solutions out there, but government.
Yeah.
I was on
Exactly.
I was on Twitter the other day, and I don't want to fall into this rat hole, but just I guess there was a statement recently made about like, hey, elections are coming up, but it's going to take a while to count all the results. Everybody, I mean, I think they're basically just trying to get out in front of challenging of election results and all that type of stuff.
Yeah.
But I was just sort of thinking, like, isn't there an existing technology called the blockchain that could basically be used to, serve as the voting platform and give us the voting results by end of the night on election day with
You would know
instant
it.
audibility, right?
You would know it instantaneously.
Yeah,
But see,
exactly.
but see, people would reject that because of two things. One, the argument would be, well, I have to register for this, and if I have to register for it, I've got to have some form of verification, like an ID. And immediately that extracts anybody that doesn't have a U.S. issued ID, right? And so, while that, and it was interesting, there was a poll out the other day about needing an ID to vote, and it was overwhelming. Like 70% of Americans said, yeah, you should have an ID to vote. You need an ID for everything else. If you want food stamps, if you want Social Security, if you want whatever it is, you want to buy alcohol, you need an ID, right? So, but so the big pushback for blockchain would be having to get people identified to be on the blockchain to do the vote. But I think it's absolutely brilliant, and somebody needs to invent it because it would give you a safe, secure, efficient, fast election.
Oh yeah. My point is, I think it's probably all invented, meaning I don't think, there already are plenty of blockchain based voting platforms. You use it for creating these DAOs, these, digital autonomous organizations that are potentially going to be an alternative to LLCs and stuff like that. I don't think it'd be very hard. I think to your point, you get a couple of coders in a weekend, you've got 85% of the platform right there.
Yeah.
It's much more, the issues that you just raised. And of course, there's a lot of people that would say, hey, there's maybe a lot of politicians that don't want something that transparent as well. Again, like I said, I do not want a rat hole on this, so let's not go into it. But it's to your point. There's a simple solution out there. There's a simple way to do it, but we're probably not going to choose it.
Yeah.
All right. The question I wanted to sort of end this jobs part on was, so the jobs data looks a lot rosier than it seems when you dig beneath the surface. And the jobs data is one of the things that the Fed is using to gauge, hey, how far should we tighten here, right? And no distress in jobs tells the Fed we can keep going further, right? You and I have talked about how jobs are a very lagging indicator, but increasingly they're looking like a very broken indicator, right? So where I'm going with this is when I was talking to James Rickards, he, said, I think the Fed is now doing the wrong thing. Like, sure, they took way too long to stop easing, and yeah, they probably needed to tighten a little bit, but I think they're doing too much now. Like the best thing they could do is to stop, because I think for the reasons we talked about earlier, organically inflation is going to start getting resolved, and that any continued hiking and tightening that the Fed does from here is just going to make the recession that ensues all that much worse, right? Worse than it needs to be. So do you share that point of view, where we now have this very lagging and now potentially broken indicator that is giving the Fed a green light to keep going higher than it needs to?
Well, no, we is the employment number broken? We can argue that all day, but it's definitely lagging, right? No argument there. And the problem for the Fed is that when we come back and do seasonal adjustments, which we will, we adjust the employment data at 12 months and then again at 36 months. So when we come back and revise this data, very likely we're going to see that employment data get revised down sharply. And we're going to look back and go, oh yeah, you should have quit hiking rates in September, right? Because the employment was rolling off the cliff at that point. It's only getting worse. But this is the problem for the Fed, is they're looking at this data going, hey, employment's fine, jobless claims are fine. The problem is there's a lot of problems with that data. And unfortunately, if you just take a look at unemployment rates, and we talked about this before, unemployment rates, they don't start slowly rising, right? And they come down really slow. It's like, unemployment's getting better. We got great unemployment, right? Everybody's got a job. Well, it doesn't slowly start to rise up the other way. It just goes straight up. And
it's the inverse of the stock market.
Yeah, exactly. And so, by the time the Fed realizes, and again, so we talked about when they break something, economically, unemployment's going to get shed very quickly. Jobless claims are going to spike. I mean, people are just going to get being laid off in droves. And, and of course, at that point, everybody's going to realize that something happens. But again, this is what the Fed said, right? If we over tighten and quote unquote break something, they're not really worried about it. They'll just, oh yeah, we broke it, so we're going to fix it now. Zero rates, more QE, everything's fine. Don't worry about it. But this is now getting us, and this is why we're just going to be perpetually in these boom bust cycles. until eventually somebody, nuts up enough to go stop this, right? We gotta figure out something.
Yeah, and what's interesting is and I get your prediction about, look, Fed's going to break something and then it's going to have to pivot, and whatever, we get around 5.25 and bang, something's going to really snap badly. What's interesting to me is that,
by the way, I don't think we get that far.
I know you don't think but it's good that you're reiterating that. So Powell, I think, has been doing the right thing in terms of saying, hey, there's going to be pain coming here, folks, right? Get ready for it. Again, one more, I'm not turning into a Powell fan, but I'm just saying he is doing some things that are right here that we don't normally see a central bank chief do. And like, if you look at like the jobs market or the housing market, two things that are definitely going to be casualties of what the Fed is doing right now. I don't think we've seen any of that pain materialize yet, right? I mean, we've been talking a lot about how things are weakening for the housing market, but we haven't seen any real pain at all yet. At least that mathematically we think we should see, just from the increase in mortgage rates alone. And according to the Fed's data, job market's still in like happy days, right? Yeah. So, I part of me feels like, unless, the engine has fallen out or the wheels have blown off the car, that Powell is telling us, like, yeah, if housing starts really shedding a lot of value, or we start seeing some of those layoffs, don't expect me to pivot right away. Now, you might disagree with him, but
no. And again, I think he's going to wait until he sees it. It's going to be too late, and then he'll pivot, and then we'll have to deal with those consequences. But it's interesting when you talk about the housing data as an example. For a while here, we haven't seen a lot of foreclosures, and where we're renting our house right now is just kind of this neighborhood where it's predominantly an area where you don't see foreclosures at all. And now there's 2 houses within 3 blocks of me that are in foreclosure. So you're starting to see, and what's interesting is one of them is somebody bought the house and they were renovating it to, I guess, flip it.
Right? Yeah.
And it's now in foreclosure, and they just stopped working on it. There's another house that I think is about to be in foreclosure, same thing. But rates are getting to that point that all of a sudden people are going, I can't sell. I bought this house at the peak of the market, so I paid too much for it. This is Elon Musk problem. I paid too much for it. Now interest rates went up, and I've been putting all this money in to renovate it to make it a flip. And now my price to sell it has dropped by 15, 20%. So I think we're going to start to see in the next year or so, particularly in the housing market, as prices drop, more foreclosures, more of those kind of issues where that feeds into that loop of people starting to go, you know what, if I'm going to sell my house, I better do it now because prices are coming down. And that's where you get that flood of inventory that really, we haven't gotten there yet, right? People aren't panic selling yet. They were panic buying before, but we're not to panic selling yet. That's still coming.
Right. I totally agree. And you and I have talked about this a lot, and I've got a housing section coming up here. So yeah, for the record, I believe all that is coming here. My whole point was, let's say that starts happening next month. I think what Powell has told us is he's going to say, tough guys, that's part of the pain I was telling you about. Like, if I still have inflation, I got to go kill, I'm going to kill that and let you guys take the pain. Right. So we'll see what happens, but at least that's the expectation he's trying to set. All right. So in the spirit of breaking something, a headline just came out recently that the Fed's foreign reserve repo is now hitting a record. I think it hit like over 350 billion last week, right? And so one of the things that we've talked on this program a fair amount about is the strength of the dollar and the carnage that has been wreaking kind of worldwide this year. And I think we're getting to the point where foreign players are really beginning to buckle, right? And of course, these record foreign reverse repos are a sign of that, right? Where they're basically reaching out to the Fed and saying, hey, you got to help us out here, buddy, right? And so I've been hearing increasingly from people that America is likely getting a lot of pressure from its allies saying, look, your strong dollar is just crushing us, buddies. You got to help us out here. So do you see these sort of record foreign repo numbers as a precursor to maybe some official action to try to
Oh, yeah.
weaken the dollar, at least temporarily, to try to help these guys out. And then if you do, then of course there's a lot of knock-on effects investment wise we would expect to see from that.
Right. Well, so two things. One, yes, the answer to your question is yes. You know, the dollar is problematic on a lot of fronts. And plus, remember, a strong dollar impacts exports, which is 40% of US revenue. So, you know, it's very problematic. And at this point, things have been navigable so far. I mean, we've been able to just kind of deal with it at the moment, but the cracks are showing. UK,
right. And mostly, sorry to interrupt, but mostly because the pain hasn't been on us, it's been on other people. Yeah.
But you know, Swiss National Bank, but you know, Canada clearly feeling the pain right now. Bank of Japan is clearly having the problem. Swiss National Bank, we've talked about that. But the U.S. Treasury itself is having problems, right? And I just wrote an article on our website at realinvestmentadvice.com talking about the next crisis is going to be a treasury crisis, and being the treasury itself needing to actually have to issue debt and find a buyer, because the one buyer they relied on for the past 12 years isn't there anymore. So, you know, that's,
and just to make it clear for folks, he's referring to the Fed.
Yeah, exactly. So, you know, there's the answer to your question is yes. I mean, you know, at some point the Fed's going to have to open up dollar swaps, doing something to try to bring down the strength of the dollar. The problem, though, and this goes back toward the start of our conversation, is that the Fed's reluctant to do that, because if they start issuing out dollar swaps, that reduces that financial tightening, right? You're now doing financial accommodation. If the dollar comes down, that's going to drive risk assets back up again, which is totally running contra to what they're trying to do by tightening policy. So he's going to really fight against, you know, look, we're going to experience some pain, but he's also going to let the rest of the world experience some pain before this is over.
All right. I'm trying to think if this is the time to get into it. Maybe we should. So interest rates continued to let me put this, yields on debt continued to rise after Powell's presser, right? And now we're at a point where, you know, just looking at U.S. Treasuries, like yields are looking really pretty good at this point. You know, still not great relative to the inflation rate, the CPI. But you know, I think the 3-month is over 4%.
Yep.
Right.
And this is the interesting thing, right? Because yields on short end debt are going up because short end debt tracks the Fed. But 10-year Treasury rates have been just stuck right around 4%. They're not moving. This is why we're starting to see more and more yield curve inversions. The 3-month, 18-month are now starting to invert.
Right.
1 year, 10 years, they're inverting. So, you know, right now, out of the 10 yield spreads that we track, we've got 60% of them now inverted, which has historically guaranteed you a recession when they begin to uninvert. So, you know, at some point, this is all going to break. Short ends are going to drop, long ends are going to drop, and you're going to uninvert the yield curve, and you'll be in the recession at that point. But to your point, you know, these short end yields are looking pretty attractive.
All right, so let's dig into this just for a second. So I did mention on Twitter the other day that if you've got just cash sitting around and you don't want to deploy it yet, right? You're keeping it for your dry powder. To me, it's getting harder and harder not to look at just laddering into, you know, some short-term U.S. Treasuries and just say, great, you know what, I'm just going to get paid around 4%. And I'll have these things, you know, basically rolling over. So at any point in time, if there's a big market correction, you know, situations change, well, I'll just have all this stuff rolling off that I can start deploying very quickly, right? But in the interim, you've got the safety of it being guaranteed by the Treasury and getting paid, you know, finally some sort of return on it, which you haven't been for the past 5+ years, right?
No, that's right. And so, you know, if I buy a 3-month, 6-month treasury, I can buy 2-year treasuries, right? That really doesn't matter because I can sell them. They're highly liquid. So if I go to my brokerage firm, Schwab, Fidelity, whoever your brokerage firm is, you call the bond desk and say, hey, buy me, you know, $500,000 worth of 2-year treasuries. It doesn't really matter the duration on the shorter end. So just buy whatever's yielding the best amount of money right now, because when yields do break and fall, you don't want to be invested in stocks at that point anyway. But when yields fall, the price of the bond will go up. So you'll then have a capital gain in your bond, and you can just sell it at any time you want, and you'll make money on the bond. So, and if not, and if yields just keep going up forever, and 2 years or 6 months or 3 months or whatever duration you buy, it'll mature, and then you can do something else with your money.
Yeah. Yeah. So it
So
seems
it's really
like
kind of a,
from a risk return standpoint, it seems like short dated US Treasuries are really pretty attractive game right now.
Yeah.
Now, of course, that leads us to the longer end of the Treasury curve, right? Where I'm going to let you update everybody in your current thinking, but your thinking for a while has been, hey, both Treasuries have had their worst year of performance, I don't know, probably ever, in the past century or so.
since
And
1789.
pardon me?
It's the worst performance in a single year since 1788.
Oh, okay. So yeah, a couple hundred years.
Yeah.
And there's probably going to be some mean reversion. B, there's probably some oversold snapback here at some point in time. But obviously, your bigger part of the thesis is look, at some point the Fed's going to have to, stop and maybe even break and reverse, and then you're going to see interest rates start coming back down again, and these long dated durations are going to see the most appreciation in that type of world, right? Now, I know TLT has been something we've been talking about and tracking a lot in this program. It has gone lower than I think most of us expected it would. It's still continuing to go down in the wake of Powell's presser. I know there's a lot of people watching that are probably, thinking, "Dear God, like, when does this thing end? And was this a bum trade?" Who knows? It probably depends on when you got in, quite honestly. But my question to you is, do you still see a lot of coiled potential there in the long duration bond?
Oh yeah. I mean, no, look, this is the thing. So if you're day trading something in your portfolio, then yeah, don't buy TLT right now because it can go lower. For me, I don't care. Right. So, it's a small position in our portfolio right now, and I'm just waiting. We're about to do a swap on duration. So we're going to sell some TLT and swap it for an extended duration bond to lengthen out that duration even more. But, my investment thesis hasn't changed. And the more that Powell does, the more that it cements in the fact that at some point when he breaks something, yields are going to reverse, and the upside, reversion to the mean, you're looking at, 30, 40, 50, 60% increases in the value of those of bonds. So, it's going to, what'll happen over the course of the next, 2 years is that bonds will outperform stocks by a wide margin. So, if I had my dithers, and I said this on the show before, I can't do this for client accounts, but if I could, I would just sell all the equities I own, and I would just buy all 10-year treasury bonds and let them sit there, either get 4% on my money, or I get one hell of a capital appreciation over the next couple of years. Again, can't do that from a money management standpoint, but I'm just saying is that, that's, the conviction to the trade is something that is longer. So you can't, if you think you're going to buy it now and make money next week, you're not. But if you're willing to buy it now, sit on it and hold it for 12 to 18 months, you're going to make a lot of money.
Okay, great. And I've heard a lot of other people sort of saying the same. Again, nobody knows with certainty what's going to happen here, but part of what we try to do on this program is zero in when we sort of see opportunities that don't come along every day.
Yeah. Well, there's certain things that occur in time, and again, it's, people crack me up, right? Because, they for 5 years now, all I've heard is like, man, if stocks ever go on a bear market, I'm just going to back up the truck. And because, back in 2008, I missed that trade. I didn't buy everything back in 2008. No, you were selling everything at the bottom of 2008. And you didn't want to buy anything at the bottom of 2008. And so now in hindsight, we look back and go, man, if I would have bought that, I would have made all this money. So now everybody's going, boy, for the last 5 years, if this market ever corrects, we get in a bear market, I'm just going to back up the truck. I can't get people to buy stocks, right? I mean, they're like, I don't want to buy anything right now. Market's going down. Well, you've got wake up, people. You've got the biggest bear market in bonds since 1788. What do you think is going to happen with bond prices next year? Not to mention 24 months from now, not to mention 36 months from now. There has never been a year where you have this big of a drawdown in almost 150 years where you didn't have a very sharp reversion in price in the next year. That's just the way math works, right? And the way markets work, and we always talk about, oh, we want to be bear market buyers. Well, hey, folks, wake up. Here's your bear market. Step up and buy it. Either have some guts or get out of the game.
Yeah. All right. Well, a lot of truth there. And that's the everyman's version of Buffett saying, be greedy when others are fearful. The problem is it's really hard to do that because it's a scary environment, right? But you got to.
That's why investing is hard.
That's why investing is hard. Well, it's also why we encourage, one of the main reasons why we encourage people to work with a professional financial advisor who can come up with the plan and has the valuation expertise to say, hey, we're at a point here where the expected return now out exceeds the risk factor, right? And most people are just being driven by their emotions and saying, oh my God, everything looks terrible right now. Why would I buy in this environment? In most cases, there comes a point where it's a great time to buy in that environment, but you need to have the experience and the dispassion to be able to recognize that.
Yeah, exactly.
All right. So a few more things before we get to your trades and also to our rant for the week. You put out an article called "Are the FANG Stocks Dead?" And I talked a bit about this with Michael, I believe last week, about the weakness that we were seeing in the generals that had been propping up the major indices. Yeah. That weakness, I think, continues since the discussion I had with Michael. So tell me, let's just dig for a minute into the thesis of your piece there and any key takeaways you think the audience would benefit from.
Well, I mean, look, there's just a ton of articles, right? Yeah, and again, here we go again, right? So the big FANG stocks are down. It's like, oh my gosh, now they're never going to come back again. Well, the FANG stocks, and again, really not talking about FANG itself. We're talking about the top 10,
right?
10
Hangman or whatever. I can't remember the latest one.
But just take the top 20 stocks.
Or Fangman, yeah.
Yeah. So you take the top 20% of the stocks in the index. Take the top 10. Here's an interesting fact for you. Apple has bought back 589. I think this. Don't quote me on the exact number, but I'm pretty close. It's well over 500 billion, but I think it's like $584 billion worth of stock over the last 10, 12 years, right? That is more than the entire market capitalization of the bottom 490 stocks in the index.
Isn't
right?
that crazy?
So the thesis is this: if you think FANG stocks are dead and you don't want to ever own them again, that's up to you. But there's three primary drivers that are going to drive those FANG stocks. And look, I get it, right? You got 10 stocks that make up more market cap than ever before in history, and fundamentally, it makes no sense. Those should all get sold off, and they should go deeply. They should crash, and there should be a new rise of 10 other stocks. And if we lived in a environment where you didn't have high frequency trading and Fed interventions and all this other stuff, then maybe we would trade on fair market, price discovery, right? Maybe we could go back to the 1980s and when we all traded on valuations and fundamentals. But that ain't going to happen, right? I mean, it's just, we have a very different environment today. But there's three factors that suggest that things will continue. Now, you may have a change, right? Meta's completely fallen out of bed, reasons. So maybe there's a new FANG stock that comes around. Maybe it gets replaced by a Procter & Gamble or something. I don't know. But anyway, whatever becomes the top 10, it is passive indexing that is going to continue to feed those stocks. I've done this analysis numerous times, but right now, 31 cents out of every dollar that goes into a passive ETF goes into those 10 stocks. So you have a consistent train of money going into these 10 stocks every time somebody buys an ETF. Apple is, I just did these stats for that piece that you're talking about, Adam. There's like 350 ETFs that own Apple. There's 280, I don't have exact numbers in front of me, but like 280 ETFs that own Microsoft and so forth with Google and all these companies, right? So every time somebody buys those ETFs, it's just funneling more and more dollars into these stocks. Then on top of that, so first you have passive indexing supporting these stocks. Then you have the stock buybacks. These are the companies, look, small and mid cap stocks, they don't have the capital to buy back tons of their stock. They don't have that much liquidity. But Apple, $180 billion of cash on their balance sheet, all these companies, they have massive war chests of just cash sitting there. And they're going, well, what can I do with this? I could go buy a company, but that's kind of risky because, I've got to absorb them and I got to try to make them work. I just go buy back shares. It suppresses my EPS. My number of shares outstanding boosts my EPS, makes me look better for earnings, and drives my stock price higher. Oh, and it benefits all my insiders because that's how we compensate them. So these are the companies that are doing all the buybacks. And as we said before, 40% of the return of the S&P since 2011 has come from buybacks alone. So now you have passive investing. Now you've got buybacks supporting these stocks. Then, of course, you have disinflation. So and I have a chart in that article of M2 money supply, which is just completely fallen off the cliff. And CPI is going to track M2 money supply. So you're about to have a very big downdraft in inflation. And in a disinflationary environment, investors are going to look for companies that can generate earnings growth. Guess who those guys are? Yeah, that's tech stocks. So again, more money going into those FANG stocks. So there's a lot of reasons to expect. And look, those valuations for a lot of these companies come down a lot. Meta trades at like 14 times forward earnings. I don't like Facebook, but it trades cheap. I mean, it's technically a fundamental, kind of a quality stock now. But a lot of these stocks have come down a lot in valuation. A lot of that overvaluation was wrung out of them. But, so you can kind of make a valuation argument on it. But even without that, there's just the function of the market that's going to drive money into those stock prices and help elevate them.
Okay, so your main point there is like, don't build your investment thesis around depending on the FANG generals being dead, right?
Yeah.
Okay, so I get all that, and I think that's great perspective for folks. One question on the passive investing, which is Bill Fleckenstein's giant mindless robot, right? It's the buying that has to happen, right? It drives prices up as long as net capital inflows into the markets are positive, but it can wreak havoc if and ever there are net outflows, right? Do you worry at all going into a potential recession, whatever, that we could get to a point where the giant mindless robot goes into reverse?
I would have suggested it should have already happened. And again, it hasn't. I mean, there's ETFs have had positive inflows all year. But again, think about this, right? So if you take a look, and there's a chart in that article of active inflows versus passive inflows, right? They're doing this. Think about this now, though. The difference is that now all these 401k plans have now shifted to ETFs to lower cost. So, as people invest in 401k plans, they're buying ETFs. We've spent 12 years now training investors. Don't try to time the market. Just go buy ETFs and just dollar cost average into these ETFs. So we've created this whole animal of just teaching people just to dollar cost average. You can't beat the market. If you can't beat them, join them. Just buy ETFs. And so I would have thought, though, with the market down 20, 21% this year, we would have seen outflows coming out of ETFs. Maybe if we go down 20 or 30, maybe we will eventually see that. But as soon as the Fed reverses course, guess where money's going?
Yeah, I also wonder too, and I'm hypothesizing here, if not to combine several different past experts' frameworks, but Brent Johnson's dollar milkshake theory, right? Which is, hey, he expects to see capital flow into the U.S. markets because there's really not a lot of alternatives for capital outside of the U.S., better alternatives. And so that may be keeping enough flows coming in to keep the flows positive, which keeps the giant robot buying and keeps the game going. What's interesting, you and I had a real long rant about buybacks, so we won't rehash that here. There is something that makes my soul die a little bit when you talk about how we have this massive passive system now, which really kind of just floods over true investing, which is, let me find the good company in the sector and the one that has the best prospects and direct capital there, right? We would hope, I would think that kind of almost sort of mindless passive investing wouldn't be sustainable. Yeah, you can have that trend for a while, but at some point it's going to find its true water and people realize there's a better way to do it. But I do die a little bit hearing you talk, thinking like, I don't know, given the world we're in, there may just always be something pumping enough money in there to keep the flows positive.
Adam, look, the problem is that, look, I'm a fundamental investor, right? I would love to have a market to where I could just buy fundamentally cheap companies that pay a dividend and, manage a portfolio that way. Problem is that I can do that, but I'll lag performance. And then, but we've created this whole Wall Street driven machine, and particularly over the last 2 years, but specifically over the last 12 since the financial crisis, where it has basically been, hey, if your advisor last year didn't beat the index, then you need to change advisors. Why? Because money in motion creates fees for Wall Street, right? So, and it's been all about, how to get investors, and this is the game. And this has been a game since 1980, when we really started first launching mutual funds. There's been mutual funds around since 1970s, but they were very few. And I've said this before, on the show, is that I can just see some guy walked into Merrill Lynch or some brokerage firm back in the 80s, said, guys, I got this great idea. We're out here trying to sell stocks every day and make a commission. And if we don't sell stocks today, we don't make any money, right? So it was all this commission trading back then. What if we just created this mutual fund, got everybody to put money into it? We charge them a 1% fee, and we just sell that. And we just tell them to stay in it and keep putting money into it. We just annuitize our business. And I'm being a little facetious about how the story happened, but that's effectively what happened. Wall Street figured out how to annuitize their business. And this is why they tell you, don't try to actively manage your money. You can't beat the index, right? It's a bunch of hogwash, because there are plenty of fund managers out there, Peter Lynch, others, who have not only beaten the index, they have slaughtered the S&P index over time. Now, they may not beat it every single year, but over time, they have slaughtered the index. And you would have made a lot more money with them than just buying an S&P index fund holding. See, this is what they don't tell you. These Morningstar is criminal, that the way they promote their ratings, because they go, this is a 5-star rated fund, and it's 1 year, 3 year, 5 year, 10-year track record is X. So you run out and buy the fund expecting to get that performance. The problem is, if you bought it in year 2 or year 4 or year 6 or year 7, yeah, that was where that bear market was, where you lost all your money. But again, the way they promote their performance, and again, you don't want to buy a 5-star fund. You want to buy a 1-star fund on the way to being a 5-star fund. So you got to learn how to, if you're going to, buy mutual funds and invest that way, you got to learn how to read the market, read the room, so to speak, and understand these marketing games that are going on, and understand where these companies are making their money, right? Are they making their money from you, or are they making them from the fund families that they're promoting? But we've developed this whole machine, and then it just went off the rails when in 2000 and 2001 and 2, after the dot-com crash, we started putting everybody online, and now it's gotten worse with Robinhood and all this other stuff. Wealthfront, Betterment, all Prospect Capital, all these companies now that are promoting these robo platforms where it says, oh yeah, just stick your money in here, we'll rebalance them for you quarterly, just keep sticking money in. These are great annuity businesses for these people, because they just keep collecting a fee, and you just keep putting more money in. And the more money you put in, the more fee they collect. I'm not saying there's anything wrong with that at all, but there's not a lot of work that goes into it. You just do this. And as long as you can just track the index, supposedly you're supposed to be happy, but nobody does the math and figures out. And I was writing an article about this the other day, and I had an advisor from Wells Fargo send me an email, and he says, thank you so much for pointing this out, which is, I was talking about this issue of getting back to even. And I wrote this article on the website at realinvestmentadvice.com talking about what happens post midterm elections. Over the past 50, 60 years, after every midterm election, the market has returned on average 18.6% on average every time you've had a midterm election. Well, see, that sounds great. Well, I'll just buy the midterm election. I'll make 18.6%. Well, the same thing is like buying after a bear market. Nobody wants to buy the market right now, just like they didn't want to buy the bottom of the bear market. But more importantly, most people are already invested. So they're already down 20, 25% this year, whatever they are. And so if I get 18.6% back over the next 12 months, or even 33% back over the next 24 months, it takes me 26% to get back to where I was in January, right? So I need almost 2 years worth of post midterm returns just to get back to even. But this doesn't account for the 6% annual rate of return I was counting on for this year, for next year, for the year after that. So there's another 18% on top of that I don't, and every year that I don't catch up to that, I'm just further and further behind the goal. And see, this is what people don't tell you about indexing. Index on the way up, index down, you don't ever really get back to your former trajectory of where your growth rate was supposed to be, because that's what the losses do to you over time.
All right. Very
And
important.
but again, nobody's going to figure this out, because Wall Street is going to keep promoting this whole passive investing thing because it's good for them. Not great for you, but great for Wall Street.
Right. And this is why my soul just died even a little bit further during this part of the conversation. So thank you. All right. We're going to do our recession watch section here, and then we're going to get to your trades, and then we'll do our rant, and then we'll let people get on with their weekends here. Okay. Just a couple of headlines to flag on recession watch. And I'll read each one, let you react real quick, and we'll bang through this. There was a report put out that 37% of small businesses can't pay their rent in full right now. So when we hear all this talk about a strong economy, it's evidence like this that really belies that claim, right? I think we keep, at least I keep feeling, sort of like in this crazy pill moment, like, am I taking crazy pills? When I kind of listen to what we're being told, but I look at the actual data, I'm just like, I don't think the words coming out of your mouth mean what you think they mean, right?
Yeah.
Yeah. All right. So,
but you're not seeing it. It's 65% of Americans are living paycheck to paycheck. And I mean, it's just, one after another in terms of this. Of course, we have Nancy Pelosi out saying that inflation's not the issue, it's cost of living. That's the same thing, Nancy.
Yeah.
But it's like, it's not unemployment that matters. It's just whether or not you lose your job. But yeah, I mean, there is just, one sign after another that a recession is coming. It's just going to be a function of time until we get there. And, we saw, 2.6% growth of GDP in the second quarter. I think that'll get revised down a little bit. I think fourth quarter might come in about flat. So, it might be flat to slightly positive, depends on what we kind of see, for Thanksgiving and Christmas spending. But I think we're going to start seeing that tick down. And then in first quarter, second quarter next year, I think that's where you run somewhere between first quarter and second quarter. I think you're going to start clicking off a negative print on GDP.
It would not surprise me. And so the next point here is corroborative of both that prediction and things that we've said on this program recently about the economy really kind of experiencing a pretty material downshift at the end of the summer. Headline is profits finally peak for shipping giant Maersk. I hope I'm pronouncing that right. But these are the massive ships you see out there on the ocean with the shipping containers that are shipping real things to and fro across the oceans. That's really slowing down. So here's the quote from the CEO. Demand for ocean shipping began its decline in August, and this was clearly observed in both rates and volumes. This was said by Maersk CEO Soren Skou. Hope I'm pronouncing that right. But then he said, we've now seen the peak in extraordinary earnings. And by extraordinary earnings, I think they mean, okay, pandemic, supply chain crunches and stuff like that. There was just massive demand for shipping, shipping stuff, right? And rates went through the roof, but that's all come down now. And he says, to underscore it, clearly the risks are to the downside going forward. So this is like the FedEx CEO quote we had, a couple of weeks ago here, where these are the guys who are actually shipping real physical things around the world. And they're waving their hands and saying, we are seeing a slowdown of stuff moving, right? It's just like saying we're seeing a slowdown of blood vessels, blood cells in your circulatory system moving through your body, right? They're just saying, look, the things are slowing. So again, it goes back to we're hearing how strong everything is, but then we look at the data and say, I don't know how all this supports still record profit margins, or near record low unemployment rates, or things like that. Like, this seems to show a economy that is on its way to your forecast of maybe a negative print by early next year.
Yeah, and there's some really interesting evidence that the economy just kind of fell off the cliff in late September, early October. And, we're kind of seeing that in some of the different data, particularly if you take, but this also is going to feed into this whole, and this is another problem for the Fed. While the Fed's looking at PCE and their median trend PCE and core prices and that type of thing, you take a look at what's happening with prices paid, import prices, export prices, backlogs, order deliveries, new orders for all these manufacturers, and they had just they were like coming down a little bit, and all of a sudden they just gone into a nosedive. And so, I mean, it's the evidence is extremely clear that the economy has hit, a pothole here. And the question, and what I thought was interesting that Powell said, he's like, the window for navigating a soft landing in the economy, I'm paraphrasing a bit here, is narrowing. And, I hate to inform him, but that window was closed, boarded up, and shuttered.
Yeah, they nailed it shut
about 2 months ago. So there is no chance for a soft landing here. The question is so a soft landing is where you get to say, 0.5% economic growth, and it kind of just stops there, right? And then you start growing again. And that's what Goldman kind of is hoping for. They're hoping that we're going to slow the economy down sub 1%, and then by the end of next year we're growing again. Things are back to normal. It's all good. I think that's wishful thinking. I think the difference we're talking about now is the difference between maybe a sub negative 1% growth and a sub negative 3% type growth thing. So, how bad is that contraction going to be? And now it's going to also be depending on what you're looking at, right? So are we looking at real GDP or looking at nominal GDP? Nominal GDP still got like 8% default, right? It's got a long way to go to get to negative. So nominal GDP is still all jacked up because of all that money that we slammed into the economy. But once you adjust it for the inflation, that's the GDP we're talking about, which is real. That is potentially going to be negative for certain first, second quarter next year. The only question will be is how negative is it going to be?
Right. And I would say, I think you think that maybe by mid next year, CPI is going to be down a lot. So the delta is going to be lower than it is right now between nominal and real at that point. Well,
CPI is going to come down pretty sharply now, once we start getting into the next couple of months, because now we're comparing against 9, 1.1, 1.2 rates of CPI change. So those year-over-year comparisons are coming down. And then you take a look at the national rent index, that's been negative 2 months in a row. And that's about to start feeding into CPI, which is 40% of that is homeowners equivalent rent. So we're about to see the biggest component of CPI start to come down.
Shrinking.
Yeah.
Great. And that's an entry into our last point here. I'm going to tell you in advance, you and I could talk about this forever. So we're going to have to really compartmentalize this part of the discussion so we can move on to your trades. Yeah. But New York Times just came out with an article headlined, "The housing market is worse than you think." And this is notable to me because I think the New York Times has been one of the many media companies out there until very recently, really kind of just cheerleading the whole, hey, homes are great again and the housing market's never going to go down, all that type of stuff. So a couple of key quotes here. Mortgage rates are sky high, prices are sky high, and there's no inventory, said Mark Zandi, the chief economist at Moody's Analytics. This may be the worst time in my living history for the home buyer. It just doesn't make sense. I'm going to add another quote to this from Danielle Hale, who's the chief economist at Realtor.com. She says, people are in wait and see mode because the numbers don't work out. So basically, I feel like we're kind of at this moment, in the housing market where like Wile E. Coyote's gone off the cliff and he's looking down, right? But gravity hasn't kicked in yet, where sellers are saying, all right, we don't want to bring our prices down and lose any money on our homes yet, right? and buyers are saying, well, I sure as heck don't want to buy at these prices right now. So it's almost kind of like this, old Western standoff, right? Where they're just looking at each other and who's going to blink first, right? Now, I think we know that with mortgage rates where they are, prices are going to have to come down, right? And there's the whole argument of, well, everybody on a 3% mortgage isn't going to sell. Fine, they don't have to. You and I have talked about this a lot. It's the margin that's going to determine what prices do anyways. But we're kind of at this moment right now where like both sellers and buyers are squinting at each other and we're wondering who's going to win the fast draw. I assume you think like I do that eventually the buyer is going to win out here.
No, what's going to happen, this is what I said earlier, is that you're going to get to the point. So first of all, let's back up real quick. Mark Zandi has never been right about anything. He's the worst economist on the planet. And again, Moody's is selling a service. So it's like here's people you don't listen to ever. The National Association of Realtors, the National Association of Retailers, Moody's, because all these, and the National Association of Home Builders, because these are organizations that support their group of people.
Right.
So
it's more of a marketing confederation. I get it. I do want to say though that he's before I let you rant on, he's not wrong, meaning that this may be the worst time in his history for the home buyer because prices are still at all-time highs and the cost of mortgages have gone back up.
Right. But he's never been right about anything. He's like Paul Krugman, right? On economics. Another guy you never listen to.
Yeah.
But anyway, there's a whole long list, right? So just take it for the grain of salt.
Take it with a big grain of salt. Yeah.
Exactly. But here's the thing we said earlier, which is the most important. Right now, we're at the point to where there's a lot of people sitting around and they're watching the equity in their home disappear. And 6 weeks ago, 6 months ago, they weren't even thinking about selling their house. But, they're older, kids are leaving for college or have left for college. They've been thinking about downsizing, but you know what? Price of the house just kept going up. And when things are pretty stable, we really don't think much about our house, right? It's kind of that last thing on the list. And, as long as things are doing all right, because again, why do we worry about our stock market portfolio so much, right? The reason that we make so many bad decisions investing is because you look at the damn thing, 15 minutes, all day long, right? And you're constantly logging in. What's the value? You can't do that with your house.
Right. And you have agency, meaning you could press the sell button tomorrow in the next minute and liquidate everything, right?
Yeah, right. But
you can't with your house.
Yeah, you can't, right? You go through the whole sell process and got to find a place to move to and all that. So, but here's the point about this. Is that there's a point to where there's a lot of sellers sitting out there. And again, what Adam said is absolutely correct. The market price is driven by the few buyers and few sellers that are willing to exchange a house at 7% mortgage rates. That pool of people is getting smaller and smaller and smaller every single day that are willing to pay that much for a mortgage or can afford to. But there's a point to where prices come down and people are sitting on a lot of equity in their house that they're, again, 80% of Americans less than $500 in the bank. Where's their equity? It's in their house. And if they're thinking about retiring soon, their plan was, I'm going to sell this house I've got because I've got $250,000 of equity in it. That's my retirement. When that retirement starts to go away, all of a sudden, you're going to see inventory. We said this earlier. You'll start seeing a lot of inventory coming to market. When the inventory comes to market with no buyers, prices come down fairly quickly. So then once prices really start to ratchet down, you're going to drag more of these people into the markets trying to capture what's left of that equity in their house. And that's how you get these big sell-offs in the real estate market, because those fractional buyers become a mass majority of fractional sellers.
Yeah, I totally agree with you. And we mentioned on this program, I've called it, there is a first mover advantage to be one of the first to bolt from the herd, right, of sellers, right? Yeah, and you were the first, right? Because you can get out pretty close to current price, right? But everybody else who comes after you is going to get a lower price. And then when the herd floods, everyone's just trying not to be the last bag holder, right? And that just really pushes the prices down fast. All right, so lots more to talk about on this. We're going to have to push it to the next one. I'll just mention that active listings were up nearly 27% year over year in September, which is what we would expect to see, right? You see an increase of inventory before you see the price cuts, right? So this is a precursor step. And as you said, Lance, and I think this is quite important, the national rent index fell by 0.7% over October, which was the second straight month over month decline, largest single monthly dip in the history of their index, which goes back to like 2017, didn't go back super duper far. But the point is that after forever of rising, we're now seeing softening in rents. That is a sign that housing is indeed cooling. Maybe even some relief coming for renters going forward, but that is not going to be a good sign for home prices. And to your point, Lance, that should be a big factor going forward in terms of pulling CPI down, because owner's equivalent rent makes such a big component of CPI. Okay, now we've gotten to the trades part of the discussion. What trades have you guys made over the past week?
Basically right now, a bit of cleanup in the portfolio, doing some tax loss selling. So specifically, we trimmed off two of our energy stocks, ExxonMobil and Devon. We trimmed off Devon just before they announced earnings. Our big concern there was that they would cut their dividend. They had a very high dividend yield relative to the overall yield of the market. And so we trimmed off our position a bit, and we were right. They did cut their dividend, brought it down to like 6%. So it's still a high dividend. So it's no complaining, but the stock took about a 12% hit. So that was a good sell for us. We also trimmed back on ExxonMobil. But also we're doing some end of year tax loss selling as well. Just going ahead and taking some opportunity here, because we're going to get ready to reposition the portfolio and shift it a bit as we head into next year, picking up a little bit more, increasing some more of the value side of our portfolio. So we trimmed off, we sold Verizon. We've owned that company for a long time. We like Verizon. We think that long-term it's a great value play, but telecommunications itself has been grossly oversold here. So again, I was reticent to sell it, but did just for the tax loss. We'll buy it back by the end of the year. But there, there's a stock that's yielding, great fundamentals, yield 7%, and has long-term capital appreciation goals in it. So, there's a decent reason for owning it. But we did swap it by buying Comcast. So we picked up a position in Comcast, sold Verizon. We'll buy Verizon back, like I said, at the end of the year. And then we also reduced our exposure to Microsoft, Apple, Google, and that's it. Just those three. Again, just picked up a little bit of tax loss harvesting for the end of the year. We'll add back to those mega cap stocks, as we start getting back into next year.
Okay. Yeah, I just want to underscore the tax loss harvesting. We talked about this maybe 2 weeks ago. I am in the process, I haven't actually made the trade yet, but in the process of evaluating the portion of my portfolio that I have in, looking for holistically tax loss harvesting opportunities, but they're most ripe in my portfolio in the mining stocks that I own. And I increased my exposure to them earlier in the year. Probably wish I had maybe, did a little bit more gardening on them, as you advised, Lance, earlier. But now what I'm thinking of doing is either a few that I'll sell and I'll just be done with. But for the ones that I want to go back into, apropos to our earlier conversation a few weeks ago, what I think I'll probably do is I'll sell them to harvest the losses. And just to make sure I'm not out of the sector, just in case it does something good over the next, 31 days, I'll put the money in like GDX, right? So I'm still getting the beta of the sector. And then I just wait until I pass the 31-day wash rule limitation. And then I can take the funds I put in there and reallocate it as however I want to at that point in time.
Well, and that's what we're also looking to do. So again, we want to extend the duration in our bond portfolio as well. So one thing we're looking at doing is selling, half of our TLT position, taking the tax loss there. We had a lot of gains. So remember, going into this year, just so everybody's aware, the reason we're doing tax loss harvesting is because when we came into this year, our portfolio was overweight equities. We were 70% equities, 30% fixed income and cash. So we reduced that in January, February, March. We reduced that 70% exposure down to 30. So we've got a ton of gains from last year sitting on our books that now are about to hit our clients. So that's why we're trying to do some tax loss harvesting here. So one thing we're looking at doing is selling half our TLT position, swapping that into a longer duration bond ETF.
Which is where you want to be anyways.
Well, and I want to bring up an important point. So I want to be there. So the wash sell rule is says that if I sell something today, I can't buy something that's equivalent to it within 30 days. So I can't sell Apple and buy Apple. That rule doesn't apply to ETFs because they're issued by different issuers. So even though I'm going from one treasury ETF to another treasury ETF, they're different issuers, so I don't trigger that tax loss. So tax loss, I don't violate the wash sell rule. So we're probably going to sell half of our TLT and buy something longer duration, still keep our weighting at about 9-10% of the portfolio, but extend that duration out a bit. Try to get to about 20 to 24 years on average. So as we start getting yields to come down, we'll get a little bit better bang for our buck next year.
Great. And what I love about that too is you want to be shifting that capital anyways. You explained why you wanted to do that. So you're making the capital shift you want to make, but you're getting a booked loss that you can then use to offset gains. So you're getting basically the prices are today what the prices are today, but going forward, you're getting the benefit of a shielding of some of that tax, which is nice.
Yeah, that's right. Now, look, this only applies to taxable accounts, by the way. So if you have an IRA, tax loss selling doesn't do anything for you. So
right. All right. So let's get to the fun part of the discussion, which is our rant. So I just finished a 5-day fast with my wife. And
you're still alive.
Still alive. Yeah. She wanted to do it. I'm trying to be the supportive spouse, said, okay, I'll do it with you, honey. And there are lots of good reasons to do it. And I've done similar things like this in the past a bit. I won't lie, it was a long 5 days. But it really wasn't that bad. It was much better than I thought it was going to be. And we followed this program where it wasn't 0 calories per day, but it was highly, highly calorie restricted. I'm talking some very thin soups, like an ounce of powder, and then you put however much water in there you want to, right? And some herbal teas. It's really not that much at all. But the main reason we did it was for the health benefit called autophagy. And autophagy or autophagy basically means consuming oneself. And the science about this is basically when your body is starved of inputs, it has to, you've got a basic metabolic set of requirements that you need to do as a body, a living body. And you need to make red blood cells and white blood cells. You got this manufacturing process going on. And so if inputs aren't coming into the body to provide the building blocks to make those things, the body has to take them from within itself. And what it does is it goes after the old and damaged impaired cells first for that. So, our bodies are constantly making new cells. The old cells kind of hang around in most cases. So what this does is it kind of goes through and just sort of cleans out all the old senescent, damaged, broken old cells, and then uses that to make the stuff that you need. So it just kind of cleans your system out, right? And there's a growing body of research and science around the benefits of this. And when you think about it, it makes total sense from an evolutionary standpoint, right? Our Neolithic ancestors, especially during winter months, they might kill an animal and they might not get another, thing to eat for the next week or 2 weeks or whatever, right? So they had these long periods where your body sort of went into this slowdown / shutdown, where it kind of, consumed on a low grade basis from itself. And then once you got food again, it would switch over and start using those inputs. So anyways, good process. But what it really kind of made me think about is, autophagy is this natural cleansing of malinvestment, right? Of again, the old stuff that the old garbage you're just keeping around. Yeah. And yet we hardly ever do it as a modern species because we have plentiful food and we have this, all right, I'm going to eat at least 3 times a day and snack in between, right? We just don't do it. We prefer not to go through the austerity of fasting, right? For the most part as a society. But I think that's a total analog to lots of parts of society, but let's start with the economy, right? We've gotten to the point where we are just intolerant of austerity. We markets just naturally follow a boom bust cycle. Business, and it goes through a boom bust cycle. You need that down cycle. You need that austerity, that harvesting of the malinvestment out of the system to be able to basically provide the foundation for the next boom cycle to happen. But we just are completely intolerant. We're like, we're like a child that just only wants indulgence. We just want candy all the time, right? And so from our politicians to our central planners, until maybe quite recently with Powell, it's always been, oh, something unpleasant is happening. Don't worry, we'll step in and intervene, right? We'll write the checks, we'll provide the liquidity, we'll bring the cost of everything that you want down. I think just like if you ignore the health benefits of keeping your eating in check, you're going to get obese and get a lot of health issues that probably lead to a poorer life and an earlier death. Same thing economically, and honestly, there's so many other parts of society we could having the same discussion about too. But I'll slow here and let you respond. But I'm curious to hear your thoughts.
No, look, it's what I said earlier, but you're absolutely right. I mean, we didn't, if putting it into, dieting terms, right? We didn't get obese overnight on debt and everything else that we've done over the last 40 years. We're not going to get out of this problem overnight, but if you want to fix, it's like going to the doctor and the doctor says, look, if you don't lose weight and start exercising, you're going to die. And, so you go home and you keep doing what you're going to do and you die, right? I mean, it's just, this is where we are. And, at some point you've got to start making that choice to, as much as you don't want to, cut back on eating, start making bad. And again, we've talked about this before with dieting and exercise and trying to do things that promote better long-term health. Because again, as we talk about going into retirement, in the last 20 years of your life, you're going to spend about $350,000 on healthcare alone. So no matter how much you got saved up in the bank, just mark 350,000 that going out the window to healthcare. Now you can spend that last 20 years of your golden years in and out of hospitals, or you can spend it, going surfing, cruising, whatever you like to do, right? That's your choice, but you've got to make those decisions, to get there and to do those right things. But those are the processes that you got to go through. And my coach has always told me, is like, all you have to do is make better bad choices. You don't have to go fast immediately, right? So, just don't, and the problem with dieting for a lot of people is they'll go on a diet for a few weeks, it fails, and then they immediately gain all the weight back because the body, they just start eating everything. The body goes, oh God, thank you, the fast is now over, so I'm just going to store everything as fat until the next time it comes along. That's why people always gain weight back and more. But as my coach always says, just make better bad choices, and this is what we need to do as a society. Financially, is just start making better bad choices. Look, we know we're going to keep bailing stuff out. We know that we're going to keep, paying people Social Security and welfare and these type of things. Make some better bad choices. Okay, if we're going to do that, let's not. For the last 50 years, we keep adding more and more people onto the Social Security rolls, right? Widows, orphans, illegal immigrants, whatever. We keep coming up with all these, new people we're going to add to the benefit rolls, but yet we have fewer people paying into it every year. So you're going to have to start making better bad choices. Okay, we're going to have to take some people off the rolls. We're going to have to delay retirement by 5 years. We're going to have to charge people, we can't have a cap at $385,000 a year for Social Security payments. That's going to have to be just however much money you make, you're going to have to pay into Social Security. So those are the better bad choices. It doesn't end the system immediately, but it starts fixing it long term. And with government, right? They're just going to have to spend less. We're going to have to figure out a way to not spend as much on government. These are tough decisions and they come with some pain, but if you don't make those decisions now, eventually the bond market's going to make that decision for you. And it's
right. And you're not going to like it.
Yeah. It's because when the bond market makes that decision, it's basically, when the doctor told you that if you don't exercise and diet, you're going to wind up dead. Well, this is the heart attack, right? When the bond market does it, it's the heart attack. You're in the hospital and it's life or death. And that's what the market's going to do for you. So you have those opportunities to make better bad choices today. politically, economically, financially, et cetera, or the market's going to do it for you.
Yeah, and I think this is kind of the point I wanted to stress home from here, which is, look, hopefully society begins to make better bad choices, right? We don't have a ton of individual agency, right, in what the government's going to decide to do and whatnot here. But I agree with you 1,000%. It should make better bad choices. I actually think that what it should do is it should learn to embrace austerity as the counterpoint to growth, to prosperity, right? If we want prosperity, we actually need austerity. And my job as the government is to manage between the two, right? There was a Pixar movie that I'm remembering came out a couple of years ago. It was called In and Out, right? And it's about all the emotions inside of you. And basically the storyline was this kid who didn't want to acknowledge the sadness emotion part. And she was miserable, and they basically figured out that, like, oh, actually sadness is an important part of a human emotion. You have to go through it. You have to go through grief to be able to get back to happiness, right? And it's the denial of it that's preventing you from actually being happy again, right? And maybe making it a health term, that old expression from the gym, right? No pain, no gain, right?
Yeah.
If you want the gain, you got to go through the pain, right? So look, I don't pretend that our opinions are going to drive, national policy tomorrow. But for everybody watching this, Lance, you and I have kids. We've talked in this program a bit in the past about, advice that we would give either younger people or people who are looking to improve their economic or otherwise station in life. And a big part of it really is, I'm going to pull another term from the gym, which is embrace the suck, right? Which is to say, hey, look, if I want to get somebody somewhere better to where I am today, I'm going to have to invest today to get there. And that investment may require sacrificing doing a lot of things that are fun, or spending money that would be fun to spend today instead of, squirreling away.
Yeah.
But really realizing that the painful part of the journey is not something to be hated or avoided. It's to actually be looked at as a positive of, okay, this is a sign that I am progressing towards where I want to be at the end of the day. And I'll tell you right now, that's something I'm really trying to kind of ingrain in my kids right now, which they're kind of maybe beginning to slowly understand a little bit. But I think it's a really important part of the equation for success, is to understand that the adversity is the essential input to the prosperity you have later on.
Yeah. And look, and again, we've had that conversation, and you're right. It's just, I've done a lot of counseling for people. What's interesting is that once you can get a husband and a wife, and generally the worst, kind of family structures when the husband and the wife aren't on the same page. He's a spender, she's a saver, or vice versa, right? But what I found interesting is that if you can get the husband and the wife on the same page and say, look, we're going to save. The goal is to save this much money this month. Just save $100, whatever it is. Then what's interesting is that once they start doing that, it starts to become a game,
Right.
where, it's like, let's see if we can save $200. Let's see if we can save $300.
And it's a source of pride and pleasure and excitement. Yeah.
And then they pay off something, right? They pay off a credit card, and it becomes this, like you said, it's a source of pride, but it's a source, you're making these goals, you're hitting these accomplishments. And, it gets people really motivated, but it's hard just to get them there, because again, whenever you throw out, again, with just terminology, right? Who wants to go to the gym? It's called working out. That just sounds tough, right? We need to come up with a better name for it. Like, hey, let's go to the gym and have fun, right?
Right.
Do something like that. Budget, it's a terrible word. It means that, I can't spend I can't YOLO, right? I'm limited on what I spend. We need to come up with a better name for that, right? But it's we have these psychological barriers, we have these emotional barriers, and then we just have really bad habits that are just taught to us, and they're taught to us by social media, who are constantly throwing ads in front of our face. Hey, buy this, buy this, buy this product. If you want to look like me, buy this product, right? And so we're constantly being inundated with these ads, offers for credit cards. Why save money? Just put it on credit. You pay for it later. And we're just taught all these bad habits rather than being taught good habits, because again, if we get everybody saving money, it's the paradox of savings, right? Get slower economic growth because people are saving money. So
Yeah, I never like that though, because I feel like if you've got excess savings, then you've got the ability to invest in the things that you want to do.
Sure.
But to your point, the whole system is trying to push us off of doing the right thing, at least the way that it's currently set up here, right? So as you were talking, I was thinking about the 50s through the 70s, you heard these stories of these mortgage burning parties.
Yeah.
Where you'd pay off the mortgage to your home and then you'd bring the mortgage paperwork out and you'd burn it and basically then throw a barbecue for all your neighbors who are there to celebrate with you.
My mom did that.
We don't do that anymore because most people don't pay off their mortgages, right? Because the system basically tells you, why would you do that, right? You can basically borrow cheap and you can get all this appreciation and
Well, and that's the problem, but that's the problem too, though. Remember when interest rates are higher, right? People buy houses they can afford. And what we've done for the last 30 years is encourage people to buy houses they really can't afford. Oh, interest rates are so cheap, you can buy this $400,000 house. Yeah, maybe you can afford the monthly payment on that house, but you can't afford the upkeep, the maintenance, the taxes, and everything, all the stuff they don't tell you about that goes on with home ownership, right? And so all of a sudden, people get in this house they really can't afford it. It just drains them financially. But we've done this, but this is, what we've done over the last 40 years of talking people into more and more debt. Why live the lifestyle you can afford when you can live this lifestyle that's well above your means because you can finance it, you get a cheap credit, you can get, low interest rates, you get free money, whatever it is. If we went back to doing like our parents did, your parents, my parents, they bought a house they could afford. And it wasn't a huge house. It was 1,100 square feet, 3 bedrooms, 1.5 bath, had a backyard, had a dog, 2 kids. And I've got an article that I just wrote for Epic Times that'll be coming out next week at realinvestmentadvice.com talking about the fact there's no middle class anymore.
Yeah.
And the reason is simply because of that. You have the top 10% and you've got everybody else. Middle class was something that people prided themselves on back in the 60s and 70s. It meant you could afford a house, you had your 2 cars, you had your 2.3 kids and a dog. And that and you had savings in the bank and you had very little debt. The only debt you had was your mortgage. That was it. Everything else you paid cash for. And that was middle class lifestyle. And that was a big chunk of America that lived in that middle class lifestyle and boosted economic growth. We no longer have that anymore.
We no longer have that. And it's a huge advantage of society. And it's a terrible disadvantage that we're losing it. There was a Fortune article I was going to put on my list. I just took it off for time's sake. That was exactly that. And you raise another huge issue that we'll have to save for a future conversation, but that the fact that we are turning into both a society, but also an economy that basically is the few favored class and then everybody else, right? So,
it's called socialism, by the way.
Pardon me?
That's called socialism, by the way.
Yeah, I mean, honestly, I think it tends to happen in most of the isms where you end up getting the wealth and the power concentrating in just a few, and that's nothing to aspire to at all. I don't think it's anything anybody listening wants. And so, anyways, we can delve deeply into that into a future one if folks are interested. Folks, let us know in the comments if you are. Let me just wrap this up by saying, one, breakfast this morning was amazing. It was like a religious experience getting to eat a real meal after 5 days. But what it did really do is 2 things. One, the whole experience just super reemphasized how few calories we really need to get by versus the immense amount of calories that the average American eats or the average Westerner eats on a daily basis, right? But also just my appreciation of a simple meal was just off the charts this morning when I had breakfast. And what that did is it really just made me appreciate living in the developed world, that how lucky we are to be able to get basically 24/7 access to food whenever we need it, right? Relatively affordable food. I know food prices have gone crazy, but it's still on a relative basis, relatively affordable. And kind of your point about sort of how older generations lived. Yeah, it was more modest means, but they had all the really important things. I mean, so much of the aspiration that drives us these days to consume and go into debt and stuff like that is honestly for a lot of stuff that really is just kind of gilding the lily. When it comes down to just being able to feed ourselves, being able to stay relatively healthy and being able to be with the people we love, that's really all that really matters.
Yeah, it is. But this is what social media, the internet, television is just constantly shoving this stuff in front of your face. Is like, if you're not living like this person over here, what's wrong with you, right? Why don't you have a Lamborghini in your driveway and a $5 million house? Why don't you have those things? What's wrong with you? And so, everything that we see, and again, most of this stuff is crap on social media, right? People just posing in front of stuff saying, oh, look at my new car. It's not their car. But and my kids are inundated with this all the time. I mean, they come to me like, hey, here's this guy, right? Look at this guy, what he's doing. And I'm like, that's not real, right? That's not what life is like. And, the problem is they're getting all this bad information that is false. I mean, we talk about misinformation as a problem. That's where it's come from. I was a very interesting survey out earlier this week. I'm going to end on this. Very interesting survey out this week. 5 out of 10 Americans get the entire majority of their news from social media.
Yeah, God, when I talked about my soul dying earlier, it really just died when you mentioned that stat. All right, well, look, folks, for all the reasons Lance and I have been batting around back and forth in this conversation, still continue to think this is a really challenging time for individual investors. And so I'm just going to give my usual plug to work with a financial advisor who understands all the macro issues that Lance and I have been talking about here. If you've got a good one already, great, stick with them. If not, consider scheduling a free, no strings attached, no commitment required discussion with the financial advisors that Wealthion endorses, perhaps Lance and his team there at Real Investment Advisors themselves. To do that, just go to wealthion.com. And if you have enjoyed this conversation, even one scintilla as much as Lance and I have, do us a favor, please support this channel by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Lance, buddy, thanks so much for hanging with me for another week here. I sense that, after the midterms next week, we're going to have a lot to talk about, and that things may actually start accelerating in whatever direction they're going to head in. I see you nodding your head here pretty violently. But I look forward to deconstructing that with you for all our viewers here next week. Everybody else, thanks so much for watching. Have a great weekend.